any two options with two different maturities, this is shorter maturity M1, this is long maturity M2. What would happen when the volatility increases? What is the relationship between volatility and premium? Sorry? I cannot hear you properly. What would happen when volatility increases? Premium also increases. Okay, now when we add time, what would happen? If the time increases also, time, that means the time to maturity increases. What happens? The premium increases. Generally, this is the story. But volatility is, we cannot use same volatility for all maturities. Volatility for a one month volatility may differ from 3 months volatility. So therefore, we have to think about it as well. So two different maturities or expiry dates. So therefore, two different volatilities we may have to apply. Then we have to think about what would happen to the 1 month volatility and what would happen to the 3 months volatility. If you think 3 month volatility to increase while 1 month volatility to decrease, what would happen? Premium on the long end option will go up while short end decreases. So if it is your expectation, then you can decide what to do. What do you do? Which option you buy, which option you sell. So whether you buy both options or whether you sell both options. What is your strategy? We expect price of one option to go up, price of another option to go down. What do you do? Sorry? Buy the 3 month option and sell 1 month. That is the whole story. Depending on your view on the volatility for different time frames, you buy or sell options with different maturities. So this is a very general case. If you think volatility will fall, what do you do? In generally, if we expect both volatilities to go down, what do you do? In which the price will fall drastically, long term or the short term. Short term premiums will fall by a large amount compared to the long term because there's a time factor. So therefore sell a short maturity and buy a long maturity. In the other example, I think we discussed what do you do if you expect in general in all maturities if volatility to go up. If volatility to go up, again short one would increase than the longer maturity. So we buy the short maturity or buy the shorter maturity and selling the longer maturity. This is obviously the reverse of the other side. One more thing, when we discuss about volatility, generally short-term volatilities are high compared to long-term volatilities, because in the long run, most of the time, long-term volatilities, especially in the case of interest rate, long-term interest rate don't change very frequently or by large amounts, whereas short-term interest rates fluctuates drastically. So this, again, we have discussed this volatility and horizontal spreads in general. Just get the idea. If volatility increase, which sector would impact? If volatility decrease, whether long-term options or the short-term options get the large impact, then what to do. But when it comes to a specific market, behavior of volatility may change from one market to another market. So you have to think about or factor in all those things when you decide your strategy. Simply, this is the case. If you expect volatility to go down, then we expect short-term premium of a short-term option goes down than the longer maturity one. On the other hand, if we expect volatility to go up, then we expect shorter maturity premiums to go up than the longer maturity options. So we buy the short end and sell the long end. That basically that's it. You decide to buy a long end or a short end and do the opposite in the other end, depending on your expectation. Which one you expect prices to go up and which one you expect prices to go down or go up by a small amount. Because we have, once you get the exposure to this volatility, irrespective of the price movement, underlying price movement, you should get exposure only to the volatility, not to the price change. That's why we do 2 transactions. Otherwise, you could have done only 1 transaction, sell a short maturity or buy a long maturity. Then you expose both to volatility and the price of the underlying. Once you do this combination, you get exposure only to volatility, because that is your call. You speculate or you expect future volatility to change.
My phone
Is it clear?
Yes, sir. In that example, in the 30th slide.
Sorry?
In the next slide, sir. We are getting a loss here, no? 4.5.
Based on the viewpoint that considers will remain steady over near term and the slight premiums, the sterling short term puts have decreased. An investor will sell the 1 month 5825 put and buy the 6 month put for a net cost of 245. So why do you say you make a loss?
The cost is 245.
This is the premium that you pay to buy, because you sell the 1 month, so it's a short term option. Premium, what would happen for a short term option premium? It is low, so you get a lower cash flow, and by the 6 month you have to pay more. Premium is high. So therefore the net cost is 245. This is not the profit or loss. This is only one factor of the profit or loss. When do you realize your profit or loss?
Sir, depending on that price of the spot
Yes.
price is
No, depending on the volatility. Say after half a month, if volatility has moved as expected, remain steady, then you might have earned the profit. That depend on your view and what is realized in the or depending on your position in this case, because you have already, depending on your view, you have taken a position short in the short end and long in the long end. So what would happen if your view realized? Just by looking at these figures, we cannot say whether we are going to make a profit or loss. We need to know what is the outcome. Say after 1 month or after 2 weeks, what is the volatility, or what has happened, or what are the premiums? Ultimately, what we need, what are the two premiums at the end?
so that profit depends on the prices at that time. No?
At that time, yes. It can, if the price difference between two options is less than this, and you will make a loss. If it is more than this and positive, then you make a profit. That's how
Okay,
it.
sir. Okay, sir.
Anything else? Any questions? If you don't have any questions, I'll start this new topic, SOPs. Can you remember we discussed one type of SOPs? What is that? There are different two types of SOPs, and we discussed one already. What is that?
For the foreign exchange?
Foreign exchange SOP or FX SOP that we discussed. What do we do in a foreign exchange SOP? What do we do in a foreign exchange SOP?
So we buy and sell on an agreed rate and agreed period.
You buy and sell.
Sell.
What do you mean by buy and sell? You buy today and you sell today. You buy
Sell
$1
on a
million.
forward.
So it can be either buy sell SOP or a
Sell buy.
sell buy. What's the difference? What does it mean by buy sell? In a buy sell, what do you do? So this is a combination of spot and generally spot and forward transaction. It can be a forward two forward date. So buy and sell. You buy one currency here while selling the other currency same day, with an agreement to sell the same amount of the base currency on a future date. So you agreed both rates today when you enter into the transaction. So from your side, this is a buy sell swap. On the other side, it is a sell buy, because other party sell base currency here and buy base currency on a future date. So this the rate applicable on the forward date is the forward rate. Today you do it at the spot price. What are the factors affecting for this forward rate, or the difference between spot and forward?
Interest rates.
Interest rates of two currencies, because here there are two currencies involved. So what matters here is the interest rate. Depending on the interest rate differential, it can be spot price can be greater than the forward price, or spot can be less than forward price. Depending on that, we say base currency is at a premium or a discount. In which case the base currency is at a premium? Case 1 or case 2? When do we say base currency is at a premium? When the spot is less than the forward. That means forward rate is higher than the spot rate. Then at this instance, base currency is at a premium. At this instance, base currency is at a discount. So the difference between forward and swap, what do we call?
Premium.
The difference?
Swap points or premiums?
Swap points. Yes, generally we call them as swap points. So that's what we discussed. We are going to discuss more types of swaps today. We can think, or we can say, FX swaps is a one special case of the swaps that we are going to discuss today. So this is a one special case. We are going to discuss more swaps in more general. So,
Sir, in a swap, it should be the same currency pair, no?
yes, in FX swap, it should be the same currency pair.
So can we use different currency pairs?
In a swap, no.
Okay, thank you.
So we are going to discuss all these. I have included credit derivatives here because there's a swap. Not all credit derivatives, but there is a one credit derivative which is a sort of a swap. We'll see how far we can move forward today. So I'll start with the currency swap. So remember, it is called as currency swaps. It is not called as FX swap. Okay, this is called as currency swaps. Again, here there are two currencies two currencies. Two currencies are involved in this currency swap. It is somewhat, or we can call that FX swap. FX swap is a, what we discuss, FX swap is a specialization of this currency. So we can consider it like that. Sometimes we call it as currency swap for simplicity, like we are saying, instead of saying foreign exchange, we say FX. Likewise, we say currency swap, but the proper word is currency swap. So without going through the slides, I'll explain what is a cross currency swap. In a cross currency swap, there can be many cash flows. There can be many cash flows at different levels. That can be decided by the parties to the transaction. What do you do here? First, you decide a notional amount. You have two currencies, say Euro USD. $1 million. What does it mean? Euro 1 million. Then you calculate based on the spot price. If this is Euro 1 million, what is the dollar equivalent? Say it is $1.2 million. That because the exchange rate is 1.2 as at today at time 0. So again, remember, when I say at time 0 and things like that, still there's that trade date and settlement date concept. So trade date may be somewhere here, and you start counting the period from this date. So minus 2 days, that is applicable. Okay. So, but I'm not going to consider that one. However, so this is the current exchange rate. This is the notional amount. We call it as a notional amount or the notional principal. Why? It is just a nominal figure that both parties agree, not necessarily to transfer between two parties. In some instances they will exchange these notional capital principal amounts. In some instances they may not do it. So basically both parties agree this notional amount. Assume 1 million. Then based on the exchange rate, principal amount of the other currency also decided. Once you decide this amount, 1 million, this is automatically comes based on the exchange rate. Then thing is, you decide, both parties decide interest rate. What is the interest rate on euro? What is the interest rate on dollar? Clear? You decide interest rate on euro and interest rate on dollar. Why? This is like, say we have two parties, party A and party B. This is try to replicate a borrowing and a lending, but it's not exactly borrowing or lending. That depends on whether you exchange this principal or not. So say party A want to pay interest on euro. That means party A acts as a borrower in euro. That's why that party pays interest in euro. Is it clear? Whenever one party pays interest in one currency, what does it mean? That party has borrowed in that currency. So even though here party A is not going to borrow borrow the principal amount, borrow anything, that party is willing to pay the interest on this notional amount at this agreed rate. Then what does party B do? That is that party pay interest on dollars. That means effectively party B borrowing dollars. Is it clear? This is like party A borrow euros, party B borrow dollars. From whom? Party A borrows euro from party B borrow dollars from party A. Both parties borrow other currency. One party borrowed dollar while lending euro. The other party borrows euro while lending dollars. That's the nature. But indeed, there may not be any borrowing or lending. What do they agree? To pay interest on one currency and receive interest on the other currency. So in this instance, party A agrees to pay interest on euro while receiving interest on dollars. Party B agrees to pay interest in dollars while agreeing to pay receive interest in euro. Pay interest in dollars and receive interest in euro. On which amount, on which principal amount they calculate the interest is these two notional amounts. So interest on euro will be calculated on 1 million euros. On dollar it would be on $1.2 million. So this is, assume this is a 3-year period and they agrees to pay interest on a semi-annual basis. So there will be 6 cash flows. So every 6 months, at the end of every 6 months, party A pays interest on the euro to party B, while party B is paying interest on the $1.2 million to party A. That's what happens. Every 6 months they pay that, or they pay that interest and receive the other. Is it clear? They just exchange interest payments on each payment date. Is it clear? Any question? So then the next thing is, what is this interest rate? That can be decided by both parties in different ways. Interest rate can be fixed. That means for the whole period, for both currencies, you fix the interest rates. Say like For euro, you pay 0.5%, while for dollar, it's 1%. So this is annual rate. Every 6 months, party A will pay 0.5% to party B on euro 1 million, whereas party B will pay 1% interest for a 6-month period to party A. So whenever you calculate the interest, now you should know how to calculate the interest amount. This is on 1 million and this is on 1.2 million. Amount is dollars, amount is euros. What would be the cash flows? Now the interest rate are fixed, so no change. So then it will be like a buying a bond. For party A is like buying a bond in dollars, because party A will receive dollar cash flows interest fixed amount on 1.2 million. For party B, it's like buying a bond in euro, because they get a fixed cash flows every 6 months. What is the amount of cash flows? Now, I'm not going to discuss that because you know how to calculate interest. This is one possible way of doing it. One party pay fixed, or both parties pay fixed interest. The second option is one party pay fixed, other party pay a floating rate. What does it mean? This floating leg is linked to a benchmark. This one linked to a benchmark such as LIBOR. Since this is in this example we are going to pay every 6 months, this will depend on the 6-month LIBOR, something like that. So then every 6 months, at this point, you have to decide what is the dollar interest rate for the next 6-month period. On this date, they have to decide what would be the interest rate for the next 6-month period. That depends on the LIBOR. Not only that, there can be LIBOR plus a margin. Again, that depends on the parties to the agreement and their credit risk. What would be the third option? On the second option, remember, even though I said euro is fixed, dollar is float, it's not necessary. You can repeat. That means euro may be at a floating rate and dollar may be at a fixed rate. One currency, interest rate on one currency is fixed while the other currency is floating. That's what does it mean by fixed float. What is the third one? What could be the other possibility? Floating. Both are at floating rate. Then you link euro interest rate to a Euribor or something like that, while dollar interest rate linked to LIBOR or something like that. That's the concept. This is the key concept or the basic idea behind a cross currency. So, any question? So why do we do this? What are the advantages? We'll discuss that. But have you got the basic concept behind this transaction? Remember, in this in cross-currency swaps, we don't net the payments. Party who is paying euro will pay the euro amount. Party who is paying dollar will pay dollar amount. There's no netting because two different currencies. That's another thing that we have to remember. Now, can someone tell me what is the similarity here, or the similarity and difference here, or why do we can say FX of is a special case of this?
In between cash flows.
There's no in between cash flows in a FX. So basically, what does it mean? It's a sort of cross currency swap with one cash flows in the future. So we don't have these cash flows. We have only this cash flow. And okay, that's based on the timing. When we think about interest rate, which is applicable out of these three scenarios? Effects of, is it a fixed one or a fixed float or float one? How do we derive the forward rate? We fix the interest on both currencies at the beginning. So it's a sort of fixed. There's no uncertainty in the future what would be the interest rate applicable for this swap. So it's a sort of fixed. But the other thing is we do sort of netting. That's why we pay, or one party pay to the other party that forward premium. The difference and the forward price, either pay or receive. That is because of we net the differences in cash flows and priced it into the swap. Not only that, on the maturity date, we exchange at the beginning and at the end, both we exchange this notional principal amount as well. Then it is not a notional amount, it becomes the principal amount because we exchange that principal amount in a FX swap transaction. So that's why we can say FX swap is a special case of cross currency swap. Remember, in a cross currency swap, it is not mandatory to exchange these notional principals. It can be with or without exchanging notional principals, but generally on this date, on the last date, on the maturity date, they exchange the principal. It may not be at the beginning, but at the end. So is it clear? Any questions? So whatever, that's what I mentioned. So this is in a graphical form. At the beginning, you can see X amount of euro is paid by party A to party B. S is the FX spot rate. So party B pays, assuming that we exchange the principal amount at the beginning. Party B pays party A X into S amount of dollars, exchange notional amount into spot rate. So in our example, 1 million and 1.2 million dollars. Party A pays 1 million euros to party B. Party B pays 1.2 million dollars to party A. But remember, it's not a mandatory thing. However, at least we assume that. We assume that party B borrows 1 million euros and party A borrows 1.2 million dollars. And in this example, both parties agree to pay floating rate. That's why it says Euro 3-month LIBOR plus alpha OIA. Assuming this is a payment frequency is 3 months. Every 3 months, both parties agree to pay interest. One party B agrees to pay Euro 3 months LIBOR plus a margin, while party A agrees to pay only 3 months LIBOR, because whatever the margin can be netted and add only into one party. The party who has to pay more margin and the party who has to pay, because this margin depends on the relative creditworthiness of party A and party B. The party who has less creditworthiness has to pay the margin. So the margin is applicable only for one part. Party B pays this floating interest rate to party A, whereas party A pays $3 months LIBOR to party B. So this will happen during the lifetime of the cross currency swap transaction. On the maturity date, other than this interest exchange, there will be the principal amount exchange as well. Remember, the same principal amount are exchanged. Irrespective of whatever the spot rate prevail on the maturity, still you use the spot rate prevail at the inception, not on the maturity. Remember that. This S is spot rate. Spot rate prevail at the starting date, not at the maturity date. So this is the basic economics behind the, or the concept behind the cross currency swap. Any question?
Can you explain about the LKR to China swap?
Which one?
That government going to have 1.5 billion Chinese yuan.
So in that case, it's more or less a sort of effects of Sri Lanka receive Chinese yuan, and we give them Sri Lankan rupees as a collateral. They keep that as collateral. Then on the maturity dates, we exchange the cash flows again. So you can it's more or less effects of. Is it clear enough?
So excuse me, is the currency swap and the FX swap are the same?
No, that's what I mentioned. It's not the same. In a FX of on the maturity date, we okay. First thing, there's no interim cash flows. In the FX of this part is not there. And even on the maturity date, we don't exchange interest in both currencies. It is factored into the forward rate, and we don't exchange the notional in that manner, but notional amounts would be X and X into forward rates. The base currency notional amount would be the same, but in the cross currency notional amount would be notional amount of the base currency into the forward rate that we agreed. So these are the principal amounts that we exchange. But here, X into S means the spot rate prevail at the very beginning. And no any other exchange rates. This is a specific specification, one specific case of cross currency swap. Cross currency swap is a general one, general product. Once we change few terms, we can derive an FX of. It is not exactly same.
Sir, I have some question. You said that it is not netted, no? So at the end, do we net that?
I didn't get that.
You say that it is not netted since it is foreign currency, two currencies I know.
Yes.
But at the end, do we net that?
No. See, no netting. You pay both. If it is netting, one party pays the other party in one currency. That's it. Whoever who has to pay more than the amount that he is going to receive, the difference is paid. That's what does it generally mean by netting. If it is the case, there won't be these two arrows. Party B pays to party A pays to party B in two different currencies. Party B pays in euro, party A pays in dollars. No netting.
So in that case, the two different currencies, two libraries, no?
Yes. LIBOR rates are the interest rates. Then you calculate the interest based on that interest rate. You get a amount. You pay that amount.
So then why do we use that alpha there?
Sorry,
Why do we use that alpha?
that's the margin. The interest rate altogether, it's not only only the LIBOR rate plus some margin. The party has to pay LIBOR rate plus a margin. This is the margin.
So that means only one party keeps the margin, or the party
Sorry, I cannot say it.
only one party keeps the margin, or
Only one party.
keeps the margin? Both should keep a margin.
Sorry, I cannot hear you.
Both parties should keep a margin, no? That only one party is keeping a margin.
Can someone answer the reason? I explained it.
In that case, we are netting that.
No, why only one party is making paying the margin? Can someone explain?
The
I explain why
creditworthiness,
one party is paying
whoever
margin.
creditworthiness can be keep margin, sir.
Sorry?
Whoever having the creditworthiness
Hmm.
can keep a margin, sir.
Yeah. Keep the margin. That means who pays the margin? With party who is having high creditworthiness or less creditworthiness?
Less creditworthiness.
Yes, the party who is having the less creditworthiness pays the margin to the party who is having the high creditworthiness, because that just to compensate the risk of that party. That's the reason adding a margin only for one party. So what I infer, I may be wrong, you were not listening to.
No, I didn't get that point. I know that.
Maybe. But don't hesitate. Ask questions.
Yeah, the thing is, the person who is having less creditworthiness don't have any margin there.
The person who is having less creditworthiness, no, he won't because what is the purpose of margin? To compensate the risk. The party who is having the creditworthiness, high creditworthiness, is taking the risk of the other party. To compensate that, he takes the margin.
The thing is, person, even though we don't have, that means we are in a short position, we can do this deal without having,
I cannot hear you properly.
without having even currencies, we can do this transaction.
Yes.
Yeah, it's a
Indeed, you need not to have any underlying transaction. Not in Sri Lanka, but theoretically, to do this type of transaction, you need not to have any underlying transaction. Say, in this instance, both parties agrees to pay floating. No? One party may speculate, say party B agrees to pay in LIBOR. What is party B's expectation on the interest rate on LIBOR? Why he agrees to pay 3 months LIBOR in euros? What is his expectation? Why do you agree to pay a floating rate?
Must be thinking the euro might come down, the LIBOR rates.
Yes, the expectation is euro LIBOR rate will go down. Then in the future, your interest expenses will be low. Meantime, since you are, as a party B, you are expect to receive dollar LIBOR, what do you expect? The opposite, dollar LIBOR to go up, then your interest income in dollars would be high. However, having said that, this is not the main intention of doing a currency. So I'll explain why do we do this currency. So the basic or the major usage of currencies. Shall I move forward then?
So this transaction can,
Sorry, transaction.
so is this transaction done in OTC market or the exchange base?
OTC. Swaps are mostly OTC.
Okay, sir. Okay.
So I have a question. Are these transactions done between banks and corporates, or how is it happening?
Either. It can be in between two banks. That means market makers or market makers, or it can be a corporate and a bank.
Okay, sir. Thank you.
Anything else? So this is the interest rate scenarios that I explained. So in this example, this is a float-in or float arrangement, but it can be fixed arrangement or a fixed float arrangement or float. That means interest rates on both currencies are fixed, but two different depending on the market condition. Two different interest rates. Dollar interest rate is different from euro interest rate, or it may different from sterling pound interest rate or rupee interest rate. Depending on the pair involved, two different interest rates will be fixed. Then it will remain there throughout the life of the transaction. But in the second one, interest rate on one currency is fixed. The other currency is linked to a benchmark rate. That's why it says float. So whatever the float side will be reset according to the payment frequency. If it is 3 months payments, every 3 months, they will reset the interest rate for the next 3 months period. In a float one, both interest rates are linked to two different benchmarks as given in this example. Euro interest rate is linked to Euro LIBOR. Dollar interest rate is linked to dollar LIBOR. Done. Okay. This example is a real usage. How do we use this currency swap? Okay, read it carefully. A UK company might expect to receive a stream of US dollars over the next 5 years from exports. Is it clear? UK is expecting a firm in UK expecting series of cash flows, annual cash flows over the next 5 years, but in US dollars. So when a UK company receives US dollars, what do they do? When a UK company receives US dollars, what do they do? There's a dollar inflow. First year, second year, third year, fourth year, fifth year. So they are expecting whatever the amount, say X amount of dollars every year. What do they have to do? They need to convert these dollars into sterling pound. Is it correct? Because that's their what is the risk? Or is there any risk?
Volatility.
Huh?
Volatility.
Volatility of what?
Currency exchange rate.
Exchange rate. Is it volatility? That volatility means going up and down. So frequent changes. But assume this is the current spot rate. Market moves. Volatility may be high because every would this be a problem? So you have to understand the concept volatility. So, if the exchange rate goes like, again, it can be the interest exchange rates change like this, or it can be like this. What's the difference in these three scenarios? So here it's the GBP USD exchange rate. What's the difference in these scenarios? So during the last coming 5 years, this is the behavior of exchange rate. What's the difference?
The USD appreciating is the risk.
In this first graph, I'll put some numbers. First one, second one, and third one. In the first one, what has happened?
There's no much of exchange movement between GBP and US dollars.
Yes. On average, exchange rate remains at the same level. There can be small ups and downs, but on average, it's very stable. But in second and third scenarios, in the second scenario, while going up and down, the trend is upward. In the third one, trend is downward. So if the exchange rate was here 1.6, here also 1.6, here also 1.6, this would be 2. This could be 1.2, something like that. So what is the risk for this UK company? Happening first one, second one, or third one?
The third one.
All of, or none of this. There can be 5 possible answers. Happen in first one, second one, third one, or all of them, or none of them. What is the risk?
Third one.
Third one. Why? Remember, the exchange rate is GBP USD. In the third one, okay, if I put at the beginning, exchange rate is 1.6. After 5 years, it is 1.2. Why this has become a risk
GBP
to the UK firm? What has happened?
GBP has appreciated.
GBP has appreciated. Why? At time 0, the exchange rate was at 1.6. At time t equals 5, exchange rate is 1.2. Exchange rate is GBP USD. Which currency has appreciated?
It's dollar appreciated against GBP.
Dollar appreciated against GBP. So is it a risk to UK firm?
Yes, it is.
Why?
During the 5-year span, the cash flows can be, what expected cash flows can be strengthened because the dollar is
Once you fix the contract, the dollar amount is fixed. That's what I mentioned. So during the next 5 years, you are receiving a flat cash flows, dollar amount. Say $5 million. Every year you get $5 million. That's what it says in the example. A stream of US dollars.
if I'm not mistaken, when you convert that into GBP, then there will be an issue.
So okay, assume this is $5 million. How much GBP you will receive if the exchange rate is 1.6?
Okay.
So UK companies benefited in that scenario.
In this scenario, UK company is getting the benefit because the cash flow is in dollars. Dollar appreciate. So that means when you receive dollars means you're having a long position. Long position in dollars. Dollar appreciate. Are you making or losing? When you have a long position and the currency appreciate, you make a profit. So you are gaining. So this is a positive movement for the UK company. First one. This is also okay. It's neutral, but it's okay. There's no gain, no profit, or basically less risky. This is the most favorable situation. Having a stable currency. That's the requirement. But in this case, exchange rate increases mean GBP, sterling pound, appreciation. So whenever the sterling pound appreciating against dollar, you have a dollar cash flow. What does it happen? What could happen? You have to pay more dollars to buy one sterling. So once you convert this $5 million into sterling, in the future you get less or lesser sterling amount. So this is negative and it's not favorable to UK company. In this example, appreciating sterling is not good for the UK. So that's the risk. As I mentioned, company prefers this one. Even though this can happen and possibilities there, firms prefer to this one. Then they know they have a fixed streams of cash flows. less uncertainty. So how this UK firm can use the cross currency swap to avoid this or hedge this position. What they want to do, convert this $5 million into sterling Y amount and make it fixed everywhere. But what UK firm can do, agrees to pay $5 million every year and receive Y amount of sterling pound. How can they do it? Take this $5 million, take the current dollar interest rate, consider this as the interest that you are going to pay every 1 year. $5 million interest is going to pay. Then what would be the notional amount of the cross currency swap in terms of dollars? Do the reverse calculation, derive the notional amount in dollars. That depends on the interest rate on dollars at a fixed rate. What would be that fixed rate? That's another concern that we have to think, how to fix this dollar rate as at today for 5-year period. So if you know this dollar rate and the interest amount, you can calculate the notional principal. So enter into a cross currency swap with the notional amount of dollars and agreeing to pay interest on dollars at this rate and agree to receive interest on sterling for the corresponding notional amount in sterling. Then your sterling cash flows will be fixed. Whatever the interest exchange rates prevail in the future, you will receive the same amount of sterling pound. So this is one of the examples that you can use to hedge your cash flows. One possibility is use a series of separate forward FX transactions for every year. So have a foreign exchange forward here to sell dollars and buy sterling. Have another one here, have another one here, have another one here, another one here. 5 different foreign exchange forward transactions. Instead of having 5 different transactions, you can combine them to one currency. So, but again, remember, not only that, you can have 5 options, 5 different options to buy sterling against dollars at a strike rate. What are the differences? If you enter into forward transaction, 5 forward transactions, what would happen? Then you have to meet that obligation irrespective of the exchange rate prevail at that time. It's like you are paying interest on dollars and receiving interest on sterling. But if you have bought 5 options, what's the advantage? You can keep this part available for you. If the exchange rate depreciates, sterling depreciates against dollar, you are in a better position, so you can get the advantage of that, but at a cost. What is the cost? You have to pay the premium. But in the by entering into 5 different FX forwards or entering into cross currency swap, you don't have to pay any cost, no upfront payment, but you give up this opportunity. So that's the difference. When you take a decision, you have to consider all those things. Is it worth to pay the upfront premium, or is it worth to go for this currency? So for the same risk to hedge, you may have more than one alternatives, different methods. Then you have to analyze and select the best option, considering your market view, the cost, and the benefits. Then you decide which product to be, or which product that you are going to use to hedge your position. So I'm not saying in this example this is the only way that you can do. No, you have other options. Entering into series of forward foreign exchange and the cross currency swap, almost same thing. But if you consider option, it's a different risk and return characteristics. So this is what I explained. Series of US dollar flows are considered as a package, and in the swap, the company agrees to pay these flows to a counterparty over the 5 years in return for a series of sterling cash flows. So it can be a fixed currency swap without principal exchanges. As I mentioned, to do this, you have to decide what are the notional amounts in dollars and notional amount in sterling. But you don't have to exchange that, because what you have to exchange these cash flows, no principal amounts here. If you agree to pay or exchange the notional amount, then again you're exposed to exchange rate risk, because you don't have dollar inflow here, which is equivalent to the notional amount. So therefore you cannot pay that. So therefore it is not required in this instance. These are the cash flows. Assume these are only the interest payments. Do the reverse calculation, decide what would be the notional amounts, and fix the interest rates. Then you can do that. So this is what I mentioned. If the exchange rate improve, that means if dollar appreciates, you will not get any benefit by entering into cross currency swap. But if you have bought series of options, all options on sterling, then you can get the benefit. You can forget about the option. You can buy at the market at a lower price. But by entering into a cross currency swap, you don't have that option. This is a sort of forward commitment type option. Can you remember at the very beginning, derivatives? We discussed about 2 different categories. One category is with having forward commitments. The other category is like a contingent obligations. Forwards, cross currency swap, all those things are fall onto the forward commitment category. Options are fall in the other category. That means it's a contingent event. Any question?
So Shanta, what are you telling was now this arrangement will cover up us only from preventing a loss, no?
Yes, possible loss.
Possible loss. So that's why it says even though if there are improvements in the rates, there's no benefit gain.
No, but you cannot. So it's like a forward contract. Whenever you enter into FX forward, whatever the market movements, whether it's in favor of you or against you, you have to meet that obligation. Here also the same thing. Once
Since
you
it's
fix
already
this,
agreed.
you have already agreed. You have to execute that. But if you bought an option, you have that flexibility. You get that flexibility at a cost. The cost is the premium that you
Okay.
pay.
Thank you.
So you protect your downside while giving up your upside.
Yeah.
So that's the cost. That's a hidden cost. Because you see, this is like a alternative available without cost.
Yeah.
Because you don't pay anything.
Yeah.
But there's a hidden cost. Hidden cost is you give up your upside.
Gain.
Your gain, yes. To protect your loss, you give up your gain. Possible gain. To cover your possible loss, you give up your possible gain. That happens in most of the cases. So that's why we call there's no free lunch in financial market. If somebody says this is free for you, be extra careful. Yes, definitely there's a hidden cost. So the next topic is on the interest rate swap. Before I move into interest rate swap, I'll explain bit on this cross currencies of why this has come up or initiated in the market. What are the advantages? So the very first cross currencies of if I remember correctly, was done between IBM and World Bank. Yes.
To derive the benefits of that, we have to agree on a fixed rate, no?
You derive the benefit?
Of this so we have to agree on a fixed rate, fixed interest rate, rather than a floating one.
That depends. The example that we discussed, to eliminate the risk in that, the best option is to go for fixed. Otherwise, you still face some problems because you receive a fixed cash flow. Okay, what would happen? You receive a fixed cash flow. So therefore, you cannot agree on a floating interest rate on dollars. Why? If we float the interest rate on dollars, future payment amounts would be vary, whereas your inflow is fixed. Then you again exposed to the market. How do you bridge the gap? But on the other hand, you can go for a floating sterling interest rate. Then what would happen? If you go for a floating sterling exchange rate, the amount that you receive will vary, go up and down depending on the interest rate prevail at that time. Whatever the interest rate, 1 year interest rate prevail this time, will decide what is the cash flow here in sterling. So would you like to take that chance? If you think sterling interest rate go up and my cash flow would be high, then you can do that. But still there's a risk. If your view is not realized, your income or the cash flow will be low in the future. So basically, firm, manufacturing firm or exporter, that sort of firm, they don't try to get any advantage or speculate on the interest rate or the exchange rate, because it is not their specialized area. They are specialized in manufacturing something or producing something or giving the service. So their main focus is that. But what they need, certainty, not the uncertainty. So to have that certainty, they prefer to have the known cash flows in the future rather than having unknown cash flows. So therefore, the best option is having dollar interest rate fixed and sterling interest rate fixed. Even you want to go for a floating rate here, you cannot go for a floating rate in dollars, because then dollar payment amounts will vary, whereas you have fixed cash inflows. Then on one day you might have excess dollars or shortage in dollars. Then how do you, what do you do with excess dollars, or how do you bridge the shortage? So you exposed to the market. So you shouldn't do that. On the other hand, to receive sterling, you can ask the counterparty to pay a floating interest rate on sterling. That can be done. Then again, you are subject or exposed to the interest rate risk of on sterling. If interest rate goes up, your cash flow increases. If interest rate goes down, your cash flow decreases. So do you want to take that risk? Depending on that, you have to select what is best for you, what is your objective. So in this example, the best option is to go for a fixed, and that firm has a certainty in the future. They know what are the exact cash flows in sterling during next 5 years. Then it's easy for their budgeting and pricing other products and things like that. Forecasting their profits, all those things are very easy. Is it clear?
Yeah. Are there any instances where we agree on a floating rate examples?
Yes. That's why in the market you can do that floating, as I mentioned. Okay. Assume you have a. I'll come back to this. Remind me. As a bank, assume you have invested in a bond, 5-year bond, semi-annual coupon, 5-year bond. I don't know, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 5-year bonds in US dollars, fixed coupon. Then you know you are receiving X amount of dollars throughout this. You think interest rate will go up, but only for the next 2 years. then again it will come down. That is your expectation. This is a bond that you have bought plus. Meantime, you might have borrowed in sterling. Then you pay in sterling. If you want to hedge and if, again, if interest rates to go up, there's a risk. So to hedge these sort of cash flows, you can use floating. No, you fix one side of floating and one side of interest rate into floating and other side fixed likewise. So but let me explain the core principle here. So as I mentioned, the very first currencies of in the world, foreign currencies of was done between IBM and World Bank. IBM wanted dollars. For whatever reason, World Bank wanted, if I remember, Swedish krona. IBM want dollars. World Bank want Swedish krona. IBM has present in Sweden, I guess, if I remember correctly. World Bank has presence in US. World Bank can borrow dollars. World Bank can borrow dollars in the market easily. Why? They have presence in US, so they can access the US market very easily. So assume World Bank can borrow dollars at 2%. Meantime, IBM, since they have presence in Sweden, they can borrow Sweden krona, say at 1%. These are the possibilities. But the thing is, IBM need dollars, World Bank need Swedish krona. So what IBM can do, borrow Swedish krona at 1% and sell it at the market and convert into dollars and generate whatever the dollar requires. Then what are the risks that they face? They exposed to the interest rate risk of the Swedish krona, which is inevitable because they want to borrow. But they exposed to the exchange rate risk. Once you sell Swedish krona and convert it into dollars, whereas you have to pay in Swedish kronas in the future, IBM exposed to exchange rate risk. The other possibility the IBM can do, go to the market straight away and borrow dollars. If they want to borrow dollars, if the interest rate may be 2.5%, because this is a Swedish firm, they don't have any dollar presence in US. Definitely there will be a margin added on that. The borrowing cost would be high. And similarly, even the World Bank goes and try to borrow Swedish krona from the Swedish market. their borrowing cost would be 1.5. World Bank can go to the market and borrow Swedish krona at 1.5, so they are happy. IBM can go to the market and borrow dollar at 2.5. The requirement is fulfilled, no exchange rate risk. But if they did it other way around, borrow from their market at 2% and convert it into Swedish krona, something like that, they exposed to the exchange rate risk. But instead of doing any of these, what they can do, IBM can borrow Swedish krona at 1%. They are not going to borrow dollars. World Bank is going to borrow dollars from the US in the US market at 2%. So then why don't they exchange these flows, agreeing IBM, World Bank agrees to pay on SEC 1.25%, and IBM agreeing to paying on dollars 2.25%. So both parties get the benefit. Instead of paying 2.5, now IBM is paying only 2.25. Instead of paying 1.5, now World Bank paying is only 1.25. So we call this the comparative advantage. So that can be done. This is the origin of this product. Indeed, IBM and World Bank, if I remember, somewhere in 1972 or 76, somewhere there, the very first transaction took place. The concept is this: different participants have different access to different markets. The bank in US, they have cheaper funding in dollars, but if they try to borrow in sterling pound, their cost may be high. A bank in London, they have cheap access to sterling pound. If they try to borrow in dollars, there will be a margin and cost of funding would be high. So both parties have this. If there's this comparative advantage, they can pass part of that to the other party and benefited both parties and go to a win-win situation. That's what happened in the cross-currency swap. So again, in this example, these are fixed. But even you go for a fixed floating or floating, that comparative advantage will be reflected in that margin. So why World Bank would like to borrow floating rate, assuming the interest rate in the future will go down. So they have to add whatever the Swedish krona floating rate plus a margin. That margin is fixed. Even the interest rate goes down, margin is fixed. If they want to reduce that margin, they can borrow in dollars and swap it into Swedish krona with a Swedish party. Then their margin will be less. That is the basic concept behind this cross-currency swap. Is it clear?
Chandra, in this example, IBM borrows for Swedish krona for 1% internally, locally.
Yes, locally.
Afterwards, they convert that whatever borrowing capital to dollars and pay World Bank.
That can be. So what they can do is IBM borrows SEC and convert into dollars and use it, because their IBM requirement is dollars.
Yeah.
They use it.
Yeah.
World Bank does the same. World Bank borrows dollars, convert it and into SEC, and they use it. But the agreement between the IBM and World Bank in the future, based on this notional principle, IBM will pay dollar interest to the World Bank. World Bank will pay SEC interest to the IBM. So whatever the cash flow received used to pay the borrowing. Whatever the cash flow received by IBM used to pay the borrowing. Or in this type of contract, on the maturity date, both parties would exchange the principal amounts as well. At the beginning, it's not a must. It's not a must to exchange the principal. As you said, IBM borrow from the borrow SEC or the Swedish krona locally, convert it with some other party into dollars and use it. World Bank borrow dollars, convert it into Swedish krona, use it. That's a completely different transaction. But to hedge the risk arising from that, these two parties can enter into a cross-currency swap, pay the interest rate on the Swedish krona to IBM, and IBM to pay dollar interest to World Bank, because ultimately World Bank has a obligation in dollars. That's the currency that they have borrowed from the market.
Yeah.
So IBM will pay that dollar amount. There may be a shortage, maybe, depending on the notional amount and the interest rate that you agree, then pass it. World Bank will pay Swedish krona amount to the IBM. IBM will pass it to his lender.
So whatever the accessible currency,
You borrow it.
they borrow on that basis and get the expense cost from the other party and set it up.
Yes. But even at the initiation or the inception, you can exchange the principal amounts. You can do that. It's not necessary not to do that or to do that. Either way, you can exchange the principal amount or not. That's a different thing.
If we don't exchange the principal amount, still on that timely basis, either party will pay the cross currency interest.
Both parties pay.
Both parties will pay the cross currency interest, no?
Yes. Interest on the currency that you borrow. Or basically effectively borrow, because even though you borrow dollars, World Bank, their requirement is in SEC, no?
Yeah.
Borrow dollars, convert into SEC. Then the World Bank will pay interest on SEC to IBM.
Exactly.
IBM will pay interest on dollars to World Bank. So whatever this flow will pass into this. That's what has happened.
Even then, Ms. Nishant, now this is the interest payments that they are paying on a monthly basis or whatever ad hoc basis. So at the end of the period,
No, sorry, it's not a ad hoc basis. There should be a
frequency,
proper
yeah.
frequency.
Yeah, at the end of the period, when the actual asset when the actual asset comes into effect, still they will have a effect with the foreign currency, no? Exchange rates?
No. That's why I mentioned, based on same exchange rate, you exchange the principals.
If you exchange the principals, then
maturity, yes.
Yeah.
That's why you do that. Then you don't get exposed to that transaction.
Yeah.
Otherwise, both parties get the exposure to no point.
Yeah.
So it's like this. At the initiation, first step, IBM borrow in Swedish krona, World Bank borrow in dollars. For simplicity, we assume you exchange the principals as well. IBM passes this SEC amount to World Bank. World Bank passes that amount, dollar amount, to IBM. Clear? The second step is the interim. IBM, World Bank, World Bank pays interest on SEC. Then IBM can pass that to the lender. IBM pays interest on dollars to World Bank. World Bank pass that to the lender in dollars. That's what happened. On the maturity, same. World Bank will pass the principal amount in SEC, notional amount. IBM will pass the notional amount in dollars. And the World Bank can pass it to the lender. IBM can pass it to the lender. Basically, this is the structure, but there are optional part. Generally, this part is optional. Instead of doing that, IBM can sell SEC and buy dollars. Here, World Bank can sell dollars and buy SEC with some other part. These two transactions with some other parties, we don't know. We don't care. All others are the major components of the currency swap agreement. Is it clear?
Yes, sir.
Okay. The other thing is, now even the concept is this: to enter into this transaction, maybe both party or only one of the parties, they don't have this transaction. They don't have it, but still they do this transaction. That can happen. No need to have the underlying transaction, have the position. No need. Still you can enter into a cross currency swap, but then depending on the cash flows, you make a profit or loss. You expose to the exchange rate and interest rate risk. To speculate, you can do that. You can enter into a cross currency swap. If you enter into a cross currency swap with a position, then you hedge your position. If you enter into this transaction without a position, underlying transaction, then you expose to the market. You speculate. Clear? Any question? Any questions?
So in the second interim payments, the World Bank has to find 6, no?
Yes. Most probably what would happen, why do they borrow SEC? They borrow to fund some activity. So that activity should generate some cash flow. They use it. That's what happened practically. They don't just borrow SEC and keep it or waste it. There should be a purpose of borrowing. In this scenario, we don't care about why do they borrow it. It's not relevant here. They borrow it, and there will be a cash flow generating project. It's not like in Sri Lanka, we borrow and eat. It's not the case. We borrow and invest in somewhere in a productive manner and generate a cash flow. Then only we can pay that borrowing. If you borrow and consume, then you will be in trouble. That's what happening here.
In that the third one is not necessary. It is not mandatory.
Sorry, which one?
Third one.
Third one, this one.
Yeah.
Generally, in a cross currency swap, this is not mandatory, but some instances they do it. Say in the previous example, this part is not there. In our UK firm example, this part is not there because it's not required. There's no cash flow to hedge. But in this example, since you have borrowed that amount and converted it into other currency, then you need this part. Otherwise, on the maturity date, both parties get exposed to the exchange rate. Both parties has to go to the market and borrow the other currency. Say in this IBM case, IBM borrows SEC and sell it and buy the dollar. So on the maturity date, so they have the dollar cash flow, then they have to convert it into SEC. If they don't have this agreement, principal exchange part, they have to go to the market and sell dollars and buy Swedish krona. Then they exposed to the exchange rate risk. Same thing happens in the World Bank side. They have to go to the market and sell Swedish krona and buy dollars. Then again, they exposed to the exchange rate risk. So they want to avoid it. To avoid that, they will consider this part as well. Then it become a part of the currency. So with principal exchange, depending on the circumstance, whether you exchange the principal or not at the beginning, at the end, or only at the beginning or only at the end, depends. Clear? Any question?
Shanta, for this transaction to be exercised, first we need to I mean, there should be two parties who are in need of these two currencies.
Whether there's a need or not, it's not a matter. They should be willing to do this.
Willing to do, that's it. So
say a bank. So these are both are institutions. If this is one party is a bank and the other party is a corporate might have the requirement to do this. Bank does not have the requirement, but bank should be willing to do this.
Okay.
Once the bank does that transaction, enter into that transaction, then the bank has to decide whether you keep it on your books or you offload it. If you want to offload it, you find another corporate to do the opposite side, or find another bank to do the opposite side. Then you hedge your position. That's what happened in the market generally. Is it clear?
Yeah.
It's the same thing. Say if you do a foreign exchange transaction, Someone as a bank, someone call you and ask for a quote, then you have to quote. You provide the quote, whether you like or not. He said, I sell. Then you have to buy. Once you buy, you don't want to keep that position. What do? You call another bank and you sell it to that bank, or find an importer who is in a need of dollars, sell that dollars. The same thing here. If you're willing to take that risk, you can keep it on your books. Otherwise, you try to offload it to another part. When there are a lot of market participants, this is not a problem. When there are not that many participants, then only this becomes a problem. Anything else?
So in that example, that party, that problem occurs if that party does not buy, no, then we have to find the party to sell.
Which party? Which example?
To whom we quoted the rate. You said that bank is quoting a rate.
Yes, the bank is quoting a $-rupee rate to a party, and that party say sell. That means the party who is asking for a price sold dollars to the bank. Then the bank has to decide whether that dollar amount, whether the bank wants to keep that dollar amount in its book or offload it. That means sell it. Depending on your risk appetite and the limits and everything and the view on the market, you have to decide what to do and take necessary actions to do that. Is it clear?
Okay, sir. Thank you.
As a market maker, you cannot refuse to quote. You have to make a quote, give a price, and accept the other party or market takers trade. Any question? But however, it's not like FX market, these cross currency swaps and things. You might have many round of discussions and bargaining and things before you enter into this transaction. If one of the party does not agree, then you may not proceed with this. That can happen in this. It's not just asking a price and executing.
Sir, but you said it is done in over the counter
Yes.
mostly.
Yes. Mostly cross currency swaps are done on over the counter basis. That's why I said both parties can have discussions, then agree on to the terms. Or if not, they can forget about it without entering into any agreement. Anything else? If you don't have any questions, yes, now it's 10:34. We'll take a break here because now we are going to start the other type of swaps, interest rate swaps. Again, it can be considered as a special case of cross currency swap. So since we are going to discuss that, start that one, take a break now. Is it okay?
So there is one thing. Is
Yes.
there any chance to get that exam paper today?
Yes, we'll post it. Yes.
Thank you.
Okay. So shall we take a break? about 15 minutes. So the next topic is interest rate swaps. Interest rate swap, IRS. So again, this is a OTC transaction, and we can say this is another special case of cross-currency swaps. What's the difference? In a cross-currency swap, there were two currencies. In a cross-currency swap, there were two currencies, but in IRS, interest rate swap, it's only a single currency. So this transaction involves interest on a single currency. But again, as in a cross currency, one party pays one interest, the other party pays the other interest. That's what happened. Since the current interest payments are in the same currency, we can net the payments. But in this instance, the first option, fixed is not possible. Fixed scenario, this is not possible, but the fixed float and float are available. So when deciding interest rates, these two payments are possible. One party pays fixed interest rate, other party pays floating interest rate, or both parties agree to pay floating interest rate on the same currency. Again, there's the concept notional is there. So parties agree on a notional amount. One party agrees to pay a fixed rate, the other party agrees to pay a floating rate. Or both parties agree to pay floating rates, but then two different benchmarks. One can be LIBOR, one can be Treasury bill rate, or something like that, or overnight repo rate, or something like that. So in the floating arrangement, both parties agree to pay a floating rate, but with two different underlying benchmark rates. That's the basic of a interest rate swap. So payment dates we call legs. Again, there can be series of cash flows, very similar to cross currency swap. There's no difference. All these are valid. The only thing is involved a single currency. Notional amount concept is there. So the first version is we call plain vanilla swap, where we have the fixed float combination. One party agrees to pay fixed rate, other party agrees to pay floating rate. So then reset date, where we have different payment frequencies. Since there's a floating rate, we have to reset the next coupon or the next interest rate. If you can remember, we discussed something called floating rate note. I specifically discussed this floating rate note and explain this reset date concept. In that, mentioning that we need that concept in the interest rate swap. That reset date is applicable not only for interest rate swap, even in the cross currency swap. So 2 days prior to the payment dates or the beginning of the next period, we set the interest rate. That's the reset date, and the effective date is from which and onwards we start counting days. Accruing interest is the interest accrued during that period, almost similar to floating rate note. And not only interest rate swaps, even the cross currency swaps, we do mark to market frequently. See who is making a profit and who is making a loss. If necessary, keep margin and reduce the counterparty risk, just because these are OTC derivatives. You take the risk of the counterparty and ultimately cancellation or the termination date. So these are just few words that may appear in a interest rate swap, especially in a plain vanilla swap. But all these terms we have discussed in some other modules. Reset date, effective date, we discuss when we discuss about floating rate note. I specifically discuss about this floating rate note because it is applicable here as well. So this is an example. Okay, we'll go through this example and explain how these interest rates of work. So again, it can arrange maybe quarterly payments, semi-annual payments, or with annual payments, or maybe monthly or weekly. Again, that's up to the market participants, but in the international market, mostly common one is quarterly payments or the semi-annual payments. And there's a principal sum, what we call the notional amount. In this example, 6 million sterling pound. So the notional amount is 6 million sterling pound. So in this case, one party agrees to pay a fixed interest rate on the 6 million pound, and the other party is willing to pay an interest based on the LIBOR on sterling pound. That's how it works. So the first payment would be March 2011, since it's quarterly. Then the second is in June 2011. The third one would be September 2011. Likewise, every three months there will be payments for a period that they agree. It's not given here whether it's a 1 year or a 5-year period. Assume it's a 2-year period, then there will be 8 cash flows during the next 2-year period.
So it is 3 years.
Yes. Hello.
So it is 3 years, no?
Yes, sorry. It's mentioned here, a 3-year plain vanilla interest rate. So this contract remains there for a 3 years. Then there will be 12 cash flows. So what would happen? Okay, at time t equals 0, assume fixed rate is, it's given, no? Fixed rate is 6%. No. 6 million fixed rate is not given. Sorry. Say it's 3%. Then the LIBOR, assume 3.1%. This is at time T0. That means on this date. This is the terms agreed, 3% and 3.1%. So what do they do after 3 months? This is party A. This is party B. Party A paying fixed rate. Party B is paying floating rate. So after 3 months, which party has the obligation? Notional amount is 6 million. Who pays to whom? Party A make the payment or party B make the payment? What is the amount?
Party B.
Party B pays because the LIBOR rate is higher than the fixed rate. The party A agrees to pay 3%. Party B agrees to pay 3.1%. So party B has to pay to party A. What's the amount?
6 million.
6 million.
No, on 6 million, sir.
On 6 million, yes, on 6 million.
0.1.
Yes, that's the thing. On 6 million, the difference 0.1%. And this is for a 1 year. But the period is only 3 months. In sterling, you may remember, for a 3 months period, depending on that 3 months period, assume there are 91 days, divide by 365. If it is dollars, you can easily take it as 90 over 360. So this is the amount that, sorry, don't get confused with this A and the this is the amount. So party B pays this amount to party A at the end of first year. But meantime, on this day, they reset the LIBOR for the next period. Assume interest rate has gone down. Now LIBOR is 3.8%. What would happen? After another 6-month period, that means from origin after 6 months, now fixed party A agrees to pay 3%, party B agrees to pay LIBOR, it's only 2.8%. So party A will make a payment to party B, which is equivalent to 6 million into 0.2 divided by 100 into 91 or 90 divided by 365. This number depends on the number of days. This is sterling that happens. Otherwise, you can take it as 90 over 360. That's how the interest rates of works. Is it clear? Is it clear?
Yes, sir.
Okay, now tell me, when do you use this product?
If there is uncertainty in interest rates,
Uncertainty in interest rates, yes. How do you eliminate that? So why somebody would agree to pay a fixed rate while the other party agrees to pay a floating rate?
When the party A's expectation to increase in interest rates?
Yes, party A expect interest rates to go up. But meantime, party B expects interest rates to go down. That's what happened.
Good.
Okay, but now tell me. You have bought a, say, bond. You have bought it. 5 million. $5 million. Coupon 2%. Now you expect interest rate to go up. What would happen if interest rate goes up?
coupon rate is 2%, no?
Coupon rate is 2%.
So we assume that the interest rate is going to go up.
Yes.
Since I've already purchased the bond, I'll have to have a difference in my interest.
What do you mean by difference in interest?
I'll have to not just only consider the coupon interest here. I'll have to consider the prevailing interest rate also for your question.
Yes.
The opportunity of increasing interest rate, you'll be losing.
Yes, that's true. So you have to think about the current interest rate. However, if interest rate goes up, what would happen to the value of your investment?
Price of the bond go down.
Price of the bond goes down, so you will incur a loss. But if you use and what does it mean? Your opportunity cost. So whatever you earn would be the yield to maturity sort of. That's the interest that you are going to earn. Now it's going to go up. Assume this is a 5-year bond. You think this will happen during the next 2-year period. This is the 5-year remaining maturity. Forget about the history. We don't know when this bond was issued, but there are 5 more years to go. You think during the next 2-year period, interest rate will go up and then stabilize or come in down. You want to get that advantage. What you can do? For make it simple, assume that interest rate is going to go above 2%. What you can do? You can enter into interest rates of for a 2-year period equal to this one, not this one, this 5-year, A fixed. And whenever you say IRS pay fixed, that means you receive floating. If you can fix that rate at, say, may not be exactly 2.2%, 2.1%. Better if you can fix it at 2%. If we've realized what would happen. Say this is semi-annual coupon. That's another factor that we have to say. Consider semi-annual coupon. If it is semi-annual, here also you have to go for a semi-annual frequency IRS. Every 6 months you make the payment. Your fixed rate is 2.1. Then what would happen? You agreed to pay on 5 million 2.1%. Floating rate is LIBOR. Assume floating rate is LIBOR. Whenever LIBOR goes up beyond 2.1, you get that cash flow. So it may compensate the reduction of this price, at least partially, or maybe fully. Even you forget about the price change, from coupon wise, you enhance your income. You receive 2% on this bond, and you receive additional amount on this difference between the fixed rate that you agree and the LIBOR rate. But on the other hand, if the LIBOR goes down, that difference you have to pay. This is one way of using interest rate swap to hedge your risk. And remember, this is when you have a long position. If you have a borrowing at a fixed rate and you think interest rate to go down, what you can do? You have a borrowing, fixed rate, and you expect interest rates to go down. What's the problem? Is there any problem? You agree to pay 10%. You expect interest rate to go down. Already interest rate is at 9%. Is there any problem for you?
We are overpaying interest if it's going down.
When the interest rate goes down, you are still paying the historical fixed rate. There's a opportunity cost. So you can get that. What you have to do, enter into a IRS. Is it to pay fixed or receive fixed? Sorry. Pay fixed or receive fixed. what do you do? You have a borrowing at 10% fixed rate. Interest rate is going down. You want to reduce your interest cost. How do you use an interest rate swap to cover that?
You prefer a lower fixed rate.
Lower fixed rate. What does it mean? No, you may not be able to fix the rate whatever you want, because that derived from the market. That based on the prevailing market rate, that fixed rate is decided for an interest rate swap for a given tenor. What is the fixed interest rate? It will be decided based on the prevailing market rates. So therefore, you cannot fix it at arbitrary figure.
So in this instance, from borrower's perspective, is it worth it to go for a floating rate, interest rate?
To pay or receive?
To receive
floating rate, to receive a floating rate when the interest rates to go down.
Yeah.
Any other views?
To pay, we have to pay
You have to.
float. So to pay, we have to float to receive net fixed.
Sorry?
To pay, we have to float that payment interest. To receive that, we have to fix that.
Yes, that's what you should do. Pay float and receive fixed. Whenever you say pay float, when the interest rate goes down, you pay less amount because your interest rate going down. You pay at that rate. So you pay float and receive fixed. So what happens? Say this is only 8%, fine. Receive fixed 8%. If this goes to 7%, what would happen? You get 1%. You get 1%, isn't it? But your obligation to pay 10%. Since you are receiving 1% from here, you pay 10%. Your effective rate would be 9%. Because you can use this 1% flow to pay this your obligation 10%. So you get a reduction in effective rating by 1% to 9%. So that's what happens. If you are a borrower, fixed rate, you go for a pay float. Assume you are a borrower at floating. What is your risk?
Interest going up.
What's the risk? Interest rates goes up. That is your risk. If interest rate goes up, your next interest payment would be high. How do you cover that position? Then what you should do? Sorry?
If you float,
You have to go for a receive float and pay fixed. Then whenever the interest rate goes up, you receive that one, you can use to pay for this, and you pay fixed, so you remain at the same level. If interest rate goes up, your borrowing cost will be almost fixed at the fixed rate, or maybe plus another margin. So I hope now you are clear about it. One more thing. Buy an IRS. What does it mean? When you say you buy an interest rate swap, it is equivalent to receiving float, because you always buy the unknown variable, unknown float. That's the concept. Whenever you say you buy IRS, you agree to receive float and pay fixed. So in this instance, you have a borrowing at a floating rate, you buy a interest rate. So in the previous case, you have an asset at a fixed rate, you sell an IRS, pay float. You can think about whenever you have a asset at floating rate, sorry, at floating rate, and what is your risk, what you should do. And meantime, you have a liability at a fixed rate, what is the risk, what you should do. Think about all these combinations. When to use IRS and how to use. Any question? Any questions, please? If you don't have any questions, I'll move forward. So that's the interest rate swap. Then a swaption. You may remember when we discuss options, we discuss about options on futures. Can you remember? We discuss about options on futures. That means we buy a call option or we buy a put option on a future. That means we get a right to buy the future, or we get a right to sell the future. So it's a derivative on a derivative. The swaption is also same. This is a combination of swap plus an option. So basically, this is an option to enter into a swap. Buyer pays an upfront sum, that's the premium, To buy the option, we pay the premium. For the right to enter into a swap agreement. So on a future date, at a pre-agreed date in the future, on the future date, we can enter into the swap agreement. Just to enter into the swap agreement. Once you enter into the swap agreement, then everything would be based on the terms of the swap. But on that date, you can decide whether you go for this swap or not. Is it clear? So in the other words, that's why it says the buyer of a option has the option to enter into a swap. If you buy a 3 months option, after 3 months, you can decide, okay, should I go for this option or not? But you have to pay a premium for that. That is a option. In swaps, again, based on this, whether it's a fixed float or float, we give some other names. Fixed float, a coupon swap. As I explained, in a fixed, it's like a coupon payment of a bond, and we exchange it against a floating rate. So therefore, we call it a coupon swap, and even a plain vanilla swap, we call the same thing. Float, it is a basis swap. You may remember what is basis. Even here, all same concept. When you have float, we use two benchmarks. One may be 3 months LIBOR, other one may be 3 months Treasury bill rate. When the interest rate goes up and down, not both interest LIBOR and the Treasury bill rate goes up by the same amount or goes down by the same amount. There will be a difference. So that difference, the difference between 3 months LIBOR and the 3 months Treasury bill rate, that is the basis. That difference won't remain fixed. That difference will change. The same concept, basis concept that we used in futures is applicable here. So the difference between these two floating rates will vary with the time. So that difference we call basis. So therefore, this float swap we called as a basis swap. Apart from that, there's another one called equity swap or a index swap. So in that case, one is a return on the equity index. Other side may be a reference rate, something like LIBOR. One party pays the return on the index, while the other party pays the LIBOR, maybe LIBOR plus margin or something like that. That sort of swap we call it as an equity swap. This index is an equity index, like all share price index or S&P 500 in US or Nikkei index in Japan, something like that. So depending on that currency, this reference rate also changes. Then the caps, floors, and collars. Again, these are combinations of more than one derivative product, maybe the series of same product. So in a cap, what we use to put a ceiling on our interest rate, basically. We put a ceiling. Our interest rate cost may vary, but we make sure that our cost won't go beyond this. We stop at this. That's why we call a cap. we establish a maximum interest that we are going to pay, especially when you have a floating interest payment. You face a huge risk. You never know interest rate, where would it be end. It can go up. So you have to pay that. But whenever you want, okay, I am willing to pay a floating rate, but not more than 6%. How do you do that? Then you have to buy a cap. This can be done through a series of options. So you can buy a series of options separately, or you can bundle them together and buy it as a cap. On the other hand, there's a flow. If you receive interest on a floating basis, you don't want that interest to go below a certain point. You want to stop here. Have a minimum interest income. Establishing that, we call it a flow. Establish a bottom flow. The interest income won't go below that. Again, you can establish this by buying a series of options or combining them all together, enter into a package product called a flow. So even the interest rate goes down, the seller of the flow will pay you the minimum interest rate. So you know your interest income will not fall below this level. In this cap, you know your interest cost won't go beyond this cap level. So that's the caps and flows basic concepts. I'm not going to go into detail how do you construct a cap or flow using options, or whether it's a call option or put option, things like that. But just have the idea what is a cap, what is a flow. Then the third one, collars, it's a combination of caps and flows. So where you establish a band, so your interest expense won't go above this or won't go below this. Your interest expense or interest income, it can be either, will remain within the band. So you have some certainty. Depending on your business, you may go for these things. It's not only for interest. These products can be used for buying any other commodity or foreign exchange, or anywhere you can use these caps and flows or collar. So basically, in a cap, you put a ceiling for your cost. In a flow, you put a bottom line for your expenses, or it can be your cost as well. You don't mind that paying this cost. No need to let it go further down or reducing your cost. You are not worrying about it, but you need the certainty. You have to have that. And the collars, you arrange a range. Within that, you are fine. It can be an expense or it can be an income. Within that band, you are happy to work. So caps, flows, and collars can be constructed using options, call options or put options, and combination of those things. So this is an interest rate collar, cap rate, and flow rate. So if the interest rate goes above the cap rate, you make only this payment at this rate, not at any of these rates. Again, when it goes down, it goes below the floor rate, but still you pay this interest rate. So effectively, your interest rate is effective rate is something like this. So after this, it exactly follows the same line. Only thing is here you're going flat. Here you are going flat. In this area also you are going flat. Your interest expense or maybe income. That's the concept of caps, floors, and collars. So when you fix these collars and the caps and floors, what do? You buy options and you sell options. So whenever you buy options, you have to pay a premium. Whenever you sell options, you have to, you receive a premium. Is it clear? Whenever you buy an option, you pay the premium. Whenever you sell the option, you receive the premium. So when you construct a collar, you can make it or create it in such a way that your cost would be 0. That means you don't pay any premium, or you don't receive any premium on net basis. How do you construct it? Whatever the premium that you have to pay, make it equals to the whatever the premium that you are going to receive. So upfront, you don't have to pay anything, but you have established a collar. So you are happy to stay in between these. But again, as I mentioned, doing a zero cost collar, it's not zero cost exactly. There's a hidden cost. Probably it may be, if the price goes below this, still you are paying this price. So it's a cost. In one scenario, that may be the case. If it is an income scenario, even if the possibility to earn an income, higher income here, you capped it here. So that's the cost that you face. But at the beginning, you don't pay any premium. So zero cost collar reduce your upfront cost. But during the lifetime, you may incur huge losses. If you remember the Sri Lankan case, oil hedging, the famous case, the situation arises I would say primarily because of a collar, zero cost collar. CPC went for a zero cost collar without understanding the risk of it. They expect, so what they did by call options here, buy and sold put options here. When they buy, they have to pay a premium. When they sell, they receive the premium. What they did, match it, adjust the strike prices accordingly, put a strike price for put options, collect the premiums which are enough to buy the call options that we require. What happens, by the time they entered into the agreement, market was of the view that oil price will go up to 200. So there was a high demand for call options. So these are very expensive. Call options were very expensive. So they have to pay a high premium. To recover that high premium, they have to sell put options with high strike. For put options, if you can remember, premium is high when the strike price is high. So they sold put options with a high strike price, somewhere around 90 or $100 per barrel. This was around 125 or something like that. I cannot remember exactly. So what happened during the very first few months, it was like this. CPC collected these gains, but with the financial crisis, oil prices collapsed. So it went all the way down up to 35. Since you have sold put options, you have the obligation to buy it at 100 or pay this $65 difference. That's what happened. Partly, not completely. There were some other conditions imposed on the product, but basically this is what happened. So the lesson here is you are an oil importer. So whatever the commodity you are going to buy, what is your risk? You want to buy oil. What is your risk? If price goes up. So if you want to do hedge using options, what do? Basically, you buy call options. So why do you buy call options? If price goes beyond this, above this, you can buy at this strike price. If it goes down, whatever you get the benefit. There's no risk for you going down. You will lose only the premium. But when this price fall is substantially high to cover the premium, you will make a profit. So was there any risk of price going down? No. There's no risk of it's basically it's not a risk for you because you are a buyer. Price goes down, it's beneficial for you. So what happens by introducing this? Flow. You took undue risk. You took undue risk here. If the price goes down below this strike price, still you commit to buy at this price. As a consumer, you should not do that. So therefore, that's why at the beginning also I mentioned these are different tools available. You have different tools and different tools have invented to serve a different or the specific purpose to use in a specific manner. So you have to use that tool in a proper way in the proper place to get the proper job done. If you use a hammer where you need to use a spanner, you won't get the desired result. It may be a disaster. You will end up with a disaster. So same thing. When you use derivative products, you should know when to use it. If you use it without knowing that, it will end up with a disaster. That's what exactly happened here. I don't know whether it was done knowingly or unknowingly, because as Sri Lankan, whatever headache we get for free, we take it. If somebody say, okay, you take it, this is free for you, you will take it, isn't it? So that's what happened. In the financial market, no free lunch. Remember that.
So then that hedging deal, the central bank was also involved.
So what we, so the it's,
Yeah, right.
yeah, I have yes, what we central bank inform CPC, hedge your risk. So we ask them to protect yourself. So then it's their job to do it properly. This is the basic thing. Okay, shall we move forward? Okay, this is an example of caps, floors, and collars. Support City PLC is a floating rate borrower that fears rate rising. It has borrowed 100 million for 3 years at 6-month LIBOR plus 25%. Sorry, 0.25%. This is the floating rate. So the risk is if LIBOR increases. If LIBOR increases, the interest cost increases. What they can do, they can buy a cap at 6%, because it's a cost. The city won't worry about interest rates going down. It's beneficial. So what they need is a cap. Notional amount is 100. So once they bought it at 6%, if interest rate goes beyond that, they will pay maximum 6%. The difference is paid by the seller of the cap. So effectively, interest cost of city is only 6% maximum. But whenever it remains below 6%, the effective rate is that actual interest rate. Is it clear? But so when it comes to collars, you might think, why someone make it a collar? Because when you make a collar, either way you give up your benefit. Say in this instance, city is a borrower. So we can understand why do they establish a cap. So they don't want interest rates to go beyond that. So they can fix it at 6%. Okay, why do they, if at all, put a floor, say 3%? Why do they do that? Few things that can happen. By doing this, so to establish the cap, they buy options. To establish the floor, they sell some options. So they can collect some premium while paying some premium. The net impact, so the net cost would be less, but they know the risk that can happen. So then they have the market information, their research or whatever. Based on that, they know interest rate, or they expect interest rate not to go down below this, or the chances. Say the chance of going down is 10% and the chance of going up is 90, say 50%. The rest 40% to remain in between this. So it's odds. What is the odds? So based on that, they can take that calculated risk. That's the one thing. Then they know. That's the thing. You should know what is your risk and return profile. If they know, while buying a cap at 6%, they sell a flow at 3%, then what is the outcome? That is one thing. Or the other thing is, in some instances, it may not exactly fit in this city example. If they have a cash inflows higher than 3%, they don't worry about paying minimum 3%. Some instances, if you can pass your cost to your customer, then you don't have to worry. So even in the CPC case, if they had some agreement at a fixed price to sell oil, then they don't want to worry about the prices going below this, because they can sell their product at a higher price. Ultimately, what that happens, customers or the individuals in the country, they have to pay high oil prices. So that's happened. If you can pass without any risk or negative impact to your customer base or whoever it is, then you can establish a flow. So all those things has to be considered. Whenever your product is inelastic, whatever the price customers are willing to buy, then you can do these things. But you have to remember, there may be a competitor that he might, or that party does not have the flow, only the cap or no hedging. When the price goes down, their production cost or the cost of raw materials is less, their production cost altogether is less. At their profit margin, they can sell at a price less than your price. Then they will grab the market. So all those risks and return are there. So from a business perspective, when you decide whatever the product that you are going to use, you have to think all those things, not only the return. What are the risks? What are the downside? Whether that taking that downside is worth. Without assuming that, or without having that knowledge, you should not enter into any of these transactions. So with that, I'll finish that topic on the interest rates, or sorry, on the swaps. So I'm going to move into credit derivatives again, just to give a brief introduction.
Sir, excuse me, sir.
Yes.
In that floor rate, when we said floor rate, you said that it is because that we may have in cash inflows that are fixed or floating, which we can adjust according. That's why that is the reason for setting a floor rate, no?
No, that's only one. Say, if we think about the cost, that is one of the reason. Because generally you don't put a float for your cost. You prefer to stay at whatever the low cost environment. Why do you put it? This is the minimum cost that I would like to incur. Nobody would do that. Oh, not nobody. Yes, generally you don't do that. If you can have the cost below that level, you prefer. But there may be instances having a flow will give you some advantages without having uncertainty even on the cost. You fix the cost. You know that this is my minimum cost. The cost won't fall below this level. Then I can price it my product at this price, and price fluctuations may be less. You maintain a stable price. Even the price goes up or goes down, you maintain your price. There can be advantages of having that, because even the buyer may prefer to enter into a long-term contracts at a fixed price. So whenever you have that advantages, then you may go for a flow. That is on the cost side. If it is an income, again then you have to think about why do you put a income on a flow. Float, sorry, you put a establishing float for your income. You prefer, because then you know your income won't fall below that level. That's the minimum income that I'm going to have. Then why do you put a cap on your income? When there's opportunity to gain any amount, but still you may prefer to put that cap there. Maybe to reduce your funding costs. If you just establish a flow, you have to pay the premium. But while establishing the flow, you establish a cap, you reduce your premium. You take the calculated risk, knowing that what is going to happen if the prices goes beyond my cap, I will lose that opportunity. That's fine. You know that, but still that cost is absorbable one. You can absorb it. Whether if it is lost, you can absorb it. Still you can survive. You know this would be the maximum loss that I can incur. So with that provisions, you can do that. Or either that cost or the loss, you may be able to pass it to someone else. Whenever all these possibilities are there, you may establish a cap or flow or both, depending on the circumstances. Generally, you don't put a flow on the expenses and cap on your income. Generally, you don't do that. Yes, true. But there can be instances doing it may be more beneficial than keep it open. Is it clear?
Okay.
Or get more confused?
No, sir.
Okay. Shall I move forward with this?
Okay.
Okay, I'll explain credit default swaps and credit spread options. Basically, these credit derivatives, these are to mitigate the credit risk. So if you lend to some party, you take the credit risk of that borrower. How do you reduce the credit risk? These three products are used to do that. I'll quickly explain these credit default swaps. Okay, I'll better switch to this without going through the presentation. See, in short, we call it CDS. There are few parties. We called one is reference entity. Reference entity. Let me see if I have put that words. That word is not, I think it's not in the reference entity. Basically, this is the borrower. Then there's a lender. We call that as a protection buyer. Protection buyer. So basically what has happened, this lender has lent some money to this reference entity. That's the borrower. Now what's the risk? Who takes the risk? And what is the risk? Borrower and the lender. Who takes the risk?
Lender.
Credit risk. Lender. Lender takes the credit risk of the borrower. If the borrower defaulted, lender loses. So lender wants to protect that. So there can be some other parties we call CDS issuers. So this is a third party, nothing to do with these two parties. This is a completely a different entity, third party, a CDS issuer. What is the role of CDS issuer is, he's selling something like an insurance to the protection buyer, telling him that, or telling the protection buyer that, or giving some assurance, if this reference entity, the borrower, defaulted, we will compensate you. CDS issuer says that if the borrower default you, we will pay you. So sell a sort of insurance. So that is the credit default swap. That is we call credit default swap. But since this is a sort of insurance, it doesn't come for free. To get that, insurer or the lender has to make a payment. What is that payment? It is a sort of premium, like you are paying a insurance premium. Protection buyer makes a payment to the CDS issuer to buy that protection. That payment is usually quoted as a percentage of the notional amount. Again, what is the notional amount? The notional amount is what is the exposure to this party. Say they have lent $10 million, or maybe buy a bond of worth of 10 million with a face value of 10 million. So this is the notional amount. The payment is quoted as a percentage of that notional amount for a particular period. For that period, like you are buying a vehicle insurance for a one year period of insurance, you pay a premium. Likewise, if during the next year this party defaulted, CDS issuer is agreed to pay the amount. So for that 1 year, you have to pay a percentage of this 10 million. That is we call CDS spread. That is we call the CDS spread. So whenever protection buyer buys the protection, the protection buyer has to pay the CDS spread to the CDS issuer. So borrower doesn't know anything about it. He just stays there. This is an agreement between these two parties. And the CDS issuer does not check with the lender whether there's any exposure to this party. It is also not relevant. Whether this lender has give or this, that's why we are not using the word lender here or the borrower here. What we use, reference entity, protection buyer, and the CDS issuer or the protection seller. So the protection buyer, that means anyone can buy a protection from a CDS issuer if that CDS issuer is willing to do that, a protection against a reference entity. So if that reference entity goes bankrupt, protection buyer will be compensated by the CDS issuer up to the agreed notional amount. So that's what happened. At the time of buying, protection buyer pays the premium. Then just like you buy an insurance, you just stay. If something goes wrong, you make your claim and the protection seller will make you the compensation. The premium is quoted as a percentage of the notional amount. We call it the spread. So if the spread increases, what does it mean? If this spread increases, that means the premium that you have to pay increases. What does it mean? This risk of this entity, credit risk of this entity increasing. That's why the protection seller needs more premium because he is taking more risk. So that's why CDS spread, we can use it as a gauge to measure the credit risk of a party. So CDS are again traded in the market openly, though it's a over-the-counter market. So they quote prices. So anybody can buy. Then the spread is given, known in the market. If you see the spread is going up, that means risk of this entity is going up. If the spread goes down, that means this entity is improving. Credit risk of this entity is going down. That's the basic concept of a CDS. Is it clear? Any question?
Can you explain why they are not called the lender and borrower?
That because of, as I mentioned, CDS issuer, he doesn't check with the protection buyer whether that protection buyer has any exposure to this reference entity, whether protection buyer has lent anything to, given anything to this reference entity. Even without any exposure, you can buy this protection. It's like you don't have a vehicle, you don't have that risk, but still you can buy a insurance from a insurance company to protect your vehicle, something like that. The protection buyer has no exposure, nothing. He has not lent any cent to this reference entity, but he is buying a protection because the protection buyer speculate that reference entity will bankrupt or the creditworthiness deteriorate, going down. Then he can make a profit. And the CDS, yes. Go ahead. Hello.
Yes, sir.
Yes.
Without having that any exposure, is there any purpose of having a CDS?
That's what I explained. This protection buyer expects the creditworthiness of this reference entity to go down, deteriorate. So when the creditworthiness decrease, this spread increase, he can sell it again, make a profit. Or even if this party bankrupt, based on the notional amount, CDS issue has to make a payment. So what the protection buyer does, basically speculate on the credit risk of the reference entity. Initially, the product is structured or created to protect lenders. So the CDS issuer, that party might have better understanding on the reference entity, evaluate the credit risk and things, then he can give the insurance to the lenders, giving this insurance protection. So lenders, they have money, they have the confidence, they lend to this party. Meantime, buying the protection from this party, paying that premium. But again, this product can be used to speculate without any exposure towards this reference entity. Protection buyers or the participants in the market speculate on the reference entity, start buying CDS. That can
So are there any CDS issuers not in Sri Lanka, no?
No, not in Sri Lanka.
Are there insurance companies or some other?
In Sri Lanka?
No, other countries.
Yes, in other countries, not insurance companies. The investment bank sort of institutions, they do this. The Lehman Brothers now no longer there. One of their business is this. They bankrupt because of this. What has happened in the Lehman Brothers story? Say reference entity has only 10 million exposure to the market, credit risk. There were CDS issuers maybe for about 50 million. Because protection buyers, even without any exposure to this party, they can buy any amount from the CDS issuer, just paying the premium. So whenever the protection buyers or the market participants see this entity is going bankrupt, they buy more. So ultimately this party fails. These are the parties like mortgage issuers, they fail. So the protection buyers, they start to make their claims against the Lehman Brothers, where they couldn't afford that because they never expect these parties to go away. So then this party also falls. That's the risk. Even so, it's like you buy the insurance from an insurance company. Whenever you need, if you go to the insurance company and make the claim, by that time, if the insurance company is not there, you are not protected. You lose not only your premium and your whatever the your valuable asset. So the same thing happens here. That can happen. So now the market think about this. Even whenever you buy CDS, then you have to think about the risk of this CDS issuer. Earlier it was not. Everybody expect CDS issuer to meet its obligation, but practically they fail to do that.
So these credit ratings are done by themselves or they are done by some other?
Credit ratings are done by rating agencies. Nothing to do with credit rating agencies. CDS issuers, they do their own evaluation on the reference entity. Based on that only they decide the spread.
Okay, sir.
Okay. So that's the basic concept on a spread. But when we say default, in the agreement, there are default events. We call that default events or the credit event. It's not just everything the other company goes bankrupt. It can be any material default. It can be a bankruptcy or failure to make a interest payment or restructuring of debt or merge with some other company or demerge, something like that, or significant fall in asset value. Say that in the contract it may say if the asset value of the reference entity falls more than 20%, then it is considered as a credit event. Then the protection seller has to compensate the protection buyer. Then the thing is, how do they make that compensation? Again, it may be two ways: cash settlement and the physical delivery. Cash settlement is now, say you have bought a bond with a face value 100. By the time of credit event happens, after the credit event, still this bond is trading at 60. So what the CDS seller would do, pay this different 40. Difference, this 40. That's the cash settlement. You pay the market value and the face value difference. Or on the physical delivery, CDS seller will pay the whole amount 100. In that instance, protection buyer has to deliver the underlying asset, or in this instance bond, to the CDS seller. So CDS seller will take that asset. So when the liquidation process goes on, he will collect whatever the proceeds, if there's any, coming through that liquidation process. So these are the basically two ways of providing the compensation for the protection buyer. That's how CDS works. And not only that, so CDS for the same entity, that can be done in different ways. Basic three types are the basics, index, and basket. In the basic, you refer to a particular asset, maybe a particular bond. So there may be a company or an entity which has issued, say, 5 bonds, but in a basic credit default shop, you exactly or specifically mention this is the bond, the entity, or this is the bond, or this is the asset that we are referring. So you link to that specific asset. If then the credit event also link to that asset, whether the interest payment is delayed or something like that. Based on that credit event, the compensation will be paid. In the next one, index, instead of a single asset, it will be a index. This is a broader one. This may not concentrate on a particular firm. This may be a collection of firms. So it can be a debt related or equity related index. So then what has happened? If the index falls below a certain level, then the protection seller will make the compensation for the protection buyer. In the basket, again, it's mostly referred to a single entity, but collection of various assets. Based on a basket of assets, the CDS is defined. This is a sort of a common arrangement. So then the credit event is defined accordingly. Say there are 10 assets in the basket, then the credit event may define as, okay, there should be two defaults. That means 2 of those assets should be defaulted to consider it as a credit event for the protection buyer to make the or get the compensation, something like that. The credit event is linked to the basket of assets. So those are the major 3 types of credit default swaps. Even though simply we say there's a reference entity, it's not only the reference entity, it can be a particular asset of the reference entity, or the particular obligation of the reference entity, a particular asset to the protection buyer. Or it can be a basket of assets. That's how it works. So there's an example. This is an airline lease and is concerned that higher fuel prices will hurt airline profits. So the bank has given loans to airlines. There are airline leases, but the problem is bank has the concern if the fuel prices increase, airline profits will decrease and they may not be able to pay the dues. So the bank ABC wants to protect that. So that's the hedge. The bank buys a basket credit default swap. So not only a particular lease, it's a collection of leases, portfolio of aircraft leases to 5 different airlines. So what is the credit event defined? There is trigger credit event when the second of the airlines applies to restructure their leases. So now there are five airlines. For whatever reason, first airline applies to restructure their lease. Okay, fine. The bank will restructure that lease and it is not considered as a credit event, no compensation from the CDS seller. But the moment the second airline applies for a restructure, then this credit event triggered and the bank ABC can go to the CDS seller and say, see, the second airline also applies for the restructure. So this is the credit event triggered. Please compensate me. So the whole 5 loans will be transferred, or leases will be transferred to the credit default swap or the credit default seller, CDS seller. CDS seller will give the bank ABC the full notional amount. That is how it happens. If it is not triggered, nothing would happen. The bank ABC just make the premium payment. That's it. Time lapses, contract expires. In a credit linked notes, this is a different sort of products where I'll explain through these. There's a borrower and a bank. The bank lent cash to the borrower, then issued a credit-linked note to investors, saying that whatever the cash flows will be depend on the borrower's payment. So the lenders will buy that credit issue linked notes, paying that amount to the bank. Then the bank will invest those proceeds in a high quality, low risk bonds. That's what happened. That's the basic structure. Then there can be different scenarios. Towards the lifespan of the credit linked note, borrower remains solvent. He makes all the payments to the bank. Then bank will pay all those dues to the investors in the credit linked notes, and bank get the return on less risky investment as well. So considering all those cash flows, everything will be paid. But the thing comes when the borrower goes bankrupt. Then the investors become borrowers' creditors. Investors absorb the loss, and the bank will recover the returns from the less risky or the safe investments return. That's what happened in the credit linked notes. Basically, the credit risk of the bank is protected by bank itself by issuing credit linked notes. That's what happened in the credit link notes. In a credit spread option, again, this is an option. So party can buy an option depending on the credit spread. What is the credit spread again? It's the yield difference between a government bond with the same maturity and a yield of a corporate bond, or the yield of a risk-free asset and the yield of a risky asset. That difference is the credit spread. So this may be 2%. This may be 2.75%. Then the credit spread is 0.75%. That's the definition of credit spread. So then in the option, strike is based on the credit spread, not this yield. Strike is not based on this yield, but the spread. The reason is, with the time, this yield, the yield of the corporate bond may change, yield of the treasury bond will also change. But we don't know what would happen to the spread. Both increases while spread decreasing. Both increases while spread increasing. Both increases while spread remains same. That can happen. So therefore we don't worry about the total yield, but we worry about the credit spread. Whether this spread widening, that means spread increases. What does it reflect? When the credit spread increases, that reflects the risk of the corporate. So therefore the strike is set for the credit spread as in any other options. Buyer pays the premium, and if the spread goes above the strike, the difference between the actual spread and the strike is received by the protection buyer. Like any option, it's sort of a call option. So you can see here, I'm trying to explain the spread here. Corporate bond yield is 3%, treasury bond yield is 2%. So the spread is 1%. There can be instances treasury bond yield remains same 2%, but the yield on the corporate bond increases to 5%. So that means the spread has widened. The next instance, the yield of the corporate bond has come down, narrowing the spread. So what matters here is the spread. So to make it simple, I kept the treasury bond yield constant, but it not necessary. Even the yield can change, and in both products, corporate bond and the treasury yield, with that the spread also changes. If the spread increases, we call spread widens. If the spread decreases, we call spread narrows. So in the credit spread option, if the spread increases beyond the strike price, the buyer of the option can exercise his right and get the difference between the strike price and the spread as a compensation against the credit risk. So those are the three products. They are to protect credit risk. Three type of derivatives, credit derivatives available in the market. So any questions? I'm going to stop here. I'm not going to discuss about asset-backed securities and mortgage-backed securities. We don't have time to discuss that. I'm going to stop here. If you have any questions, you can ask.
So in the credit spread option, if the margin spread narrows, the seller does not have to pay anything.
Option in the credit spread option, if the spread narrower, then
that seller of that
yes,
doesn't have to pay.
as long as spread remains below the strike, as long as the spread remains below the strike, the option buyer won't exercise anything, or he has no right to exercise. So option seller has to need not to pay anything. It's almost like a call option. The option seller will get the obligation only if the market price goes above the strike price. In a call option, same concept. Anything else? So from next week and onwards, we are going to discuss asset liability management. In that, most probably the interest rate swaps and the duration, those concepts will be required when you do asset and liability management. So please refresh your knowledge on those and attend the classes. Once you finish that ALM, again we'll then we'll discuss risk management. Whenever we discuss risk management, there may be some links to the asset liability management, and definitely we are going to use these derivative products to manage our market risk. In the risk management, we mainly focus on the market risk. We'll discuss a bit only a bit on credit risk. Liquidity risk and liquidity risk mostly covered under ALM. So if not, we'll discuss that one as well. So that's our future plan. So the message here is you need to know about duration concept, duration, convexity, interest rate swaps, especially when you go into ALM. That's the message that I want to pass you. So if you don't have any questions, we can stop here.
So is there any information about that paper?
What paper? Past paper?
No, that last week the exam had been.
Yes, that's what we'll upload it today.
Is there any idea about our next when is our next assignment, sir?
Yes, next assignment towards the end of ALM module. We'll give you the assignment. Maybe that means now, yes, September 2nd week, around September 2nd week, we'll give you the second assignment.
It will be individual or no?
Yes, we cannot do it in a group way in this setup.
Okay, sir. Okay.
Do you think you can do a group assignment in this environment?
No, sir. No.
I don't think.
Thank you, sir.
Okay, anything else?
That's a forward-based agreement, so do we discuss that? There's a huge forward-based agreement.
Yes, that FRAs. Yes, we will discuss after once you finish ALM, because I promised Perry to hand over the class by next week to start ALM. So that's why I take that IRS or interest rate swap and swap class today, because it is required in the ALM, but not the FRAs. So we can discuss after that. We'll discuss that.
We will discuss that asset-backed security.
Sorry?
That will be also discussed, asset-backed security.
Asset-backed securities we can discuss. Now we cannot do because we don't have time now. So, but yes, we can discuss that. Anything else? So it seems you don't have any questions. So shall we stop here?